Welcome to Far From Wall Street. This is Michael McCall. The nation's economy grew just 0.7% last quarter, less than what was expected and the slowest rate in 3 years. But it was greeted with a collective yawn by investors. Why? Well, the main reason is that a slow growth rate for the quarter was expected. Earlier this month, economists at the Atlanta Federal Reserve had projected a growth rate of just 0.4%. In addition, a big pickup is expected for the next 3 quarters of 2017. The 61 economists surveyed in early April by the Wall Street Journal expected quarterly growth to average 2.6% for the 3 remaining quarters of 2017. Also, government economists are sharpening their pencils because first quarter growth has been consistently low. Since 2010, the average first quarter growth rate has been over 1% less than each of the other quarters of the year. The Bureau of Economic Analysis is considering making adjustments to smooth out the seasonal factors in measuring the economy. The 4 cylinders driving the economy are shown here, and the main driver, personal consumption, dropped sharply. While personal consumption expenditures account for 70% of U.S. economic activity, the sharp drop is not cause for alarm. The sharp drop in consumer spending was mostly attributable to a decline in vehicle sales, and auto sales are merely reverting to their long-term mean. Coming back from a slump in early 2009, auto sales have long been above their long-term mean for 2 years, and that level was unsustainable. So the drop in consumer spending is likely not an indicator of the future. In fact, consumers are feeling pretty good. According to the University of Michigan's monthly survey in April, consumer sentiment ticked up. Despite the weak growth in the first quarter of 2017, economic conditions that traditionally accompany bear markets, restrictive Fed policy, slowing GDP growth, stock price overvaluation, and irrational exuberance, are not on the horizon. After the low growth rate for the first quarter was announced, the stock market dropped fractionally, but it remained near its all-time high. Current events like the Syrian refugee crisis and threat posed by North Korea heightened uncertainty about the future, and the tax cut everyone expected and which sent stocks soaring early in 2017 may never happen given the size of the federal deficit. So it is prudent to expect a 10 or even 15% drop in stock market prices at any time, while keeping in mind that the near-term direction of the stock market is highly unpredictable. Given the growth expected for the rest of 2017, stocks could continue their 8-year ascent and head higher still, making it wise for retirement investors to stay focused on the long-term economic trends and to invest strategically to achieve your goals. Please contact my office with any questions or to set up a meeting. And don't hesitate to share this video with friends who might benefit from my work. Remember, it's great to be far from Wall Street.